Welcome to the second hour of Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm pleased to have with me once again David Jensen. David joins me almost every week to give us an update on the markets, particularly the precious metals markets, but also markets that are very much interrelated with the precious metals markets. Thank you for joining me again, David.
Jay, my pleasure.
Let's start with the GOFO rate. We're looking at are we looking at a premium again for GOFO? Gold is trading higher in the short term or not?
The gold forward rate is trading this morning. It's or as of Friday, pardon me, 0.094%. So it's roughly at zero, hovering there in that zone. So there's a slight premium for lending U.S. dollars versus lending gold. But it's for all intents and purposes, it's next to nothing. So they're both basically equal right now. But what is interesting, I think, is what we talked about last week in terms of the Shanghai metals market and some of the premia for the other precious metals that we're seeing there.
Right, indeed. And, of course, I think most outstanding is platinum and palladium. Yeah,
we were seeing last Wednesday, the palladium was trading at about $125 per ounce premium.
Wow.
On the Shanghai Metals Exchange versus the New York London pricing.
And we're talking platinum. Is that platinum?
That was palladium.
Palladium, okay.
It was $125 an ounce on Wednesday, July 2, and then platinum. So that was roughly 15%.
Wow.
And platinum was trading at about an $80 premium. And from Wednesday to Friday, July 4th, the palladium premium had risen to $132 an ounce, and platinum had risen to $91 per ounce premium. So, and I think for context, to put it into kind of a bigger picture perspective here, the fact that these premia exist and aren't extinguished, I think, is very unusual. If we take a 400-ounce good delivery bar and we were to fly it from New York to Shanghai, delivery of that 400-ounce bar should give us a $52,000 profit, given the pricing differences between those two markets.
Right. So why wouldn't the arbitrage set in?
You got it. And it's to move these good delivery bars between major centers is about $1.50 an ounce. So when you can generate $132 per ounce premium, those premiums should be extinguished right away.
Yeah.
And they're not.
That's incredible. So the explanation is what? It's not there. It's not available.
It's not available. It's an these good delivery bars are a little over 30 pounds a piece, and so an individual could carry a 30-pound bar and walk into Shanghai and in a short period of time generate $52,000 profit, and it's not happening. So, it tells me that the paper pricing and the paper trading is one story, and then the physical market with its own supply and demand curves and pricing sensitivities is another. And I think that these two markets appear to me to be at the very front of a phalanx of incipient change coming to the precious metals market.
So you think there's some connection between the platinum palladiums on the one hand and the gold and the silver on the other?
I think platinum and palladium in particular, because there's so little overhang in the market that they're very responsive in terms of supply demand, and you're seeing that on the physical market side in Shanghai. Silver itself has been running a 5 or 6 percent premium. It's about 2.5% now, but that in and of itself is interesting as well. And we're seeing the very strong drawdowns in the silver stockpiles in Shanghai as well.
Yes.
So I think that in terms of sensitivities to price structures and supply demand, platinum and palladium seem to be the ones that are really the ultra sensitive instruments to follow, followed by silver, and then ultimately followed by gold because of the large holdings in the official sector, namely the central banks and the treasuries around the world.
Well, David, help me understand why there would be a connection between these metals. I mean, platinum and palladium are completely different than silver or gold. Gold especially is almost entirely a monetary metal. Platinum and palladium are used in industry dramatically. Silver, to a great extent, is used in industry. Why would not the fundamentals for platinum and palladium be complete? Why would the fundamentals for platinum and palladium be the same as those for gold and silver?
Well, I think what all of those metals share in common is that you can't print any of them.
Mm-hmm.
And as a consequence, when you print money, eventually, you initially have the markets are quote unquote stimulated, but ultimately all that printed money flows into real assets. And we've seen that historically that platinum has moved in advance of silver, and both silver and platinum have moved in advance of gold. When the consumer goods price wave, price moves hit the market.
Mm-hmm.
So it's that to me is as succinct a description as I can give it, Jay. Is that I know that platinum and palladium aren't particularly monetary metals, but you can't print them, and they are precious metals.
Mm-hmm.
And when the money printing results in consumer goods price inflation, it seems to move the rarest and the ones that have the smallest amount of overhang in the market first.
Right. So platinum and palladium are extremely small markets. Silver somewhat larger, and the gold a lot larger than all of them. And so, if I hear what you're saying, you're suggesting perhaps that there's some people that are starting perhaps to buy these metals and hold on to them, perhaps as an inflation hedge. Or they're worried about their currency being in decline, and with that, of course, you have in platinum and palladium, unique to that, to those two metals, are supply constraints in South Africa as well. And
for a whole raft of reasons, they're moving up in price. But you can't say it's a factor. But oil moves up in price as well, and it's not necessarily because consumers are buying and holding oil, right?
Mm-hmm.
It's ultimately just the wash of fiat currency into real assets that drives up the market price of these things.
Right.
So we're also seeing the silver stockpiles being drawn down as well, as you and I discussed earlier, and they've fallen quite strongly now. They're down to 200 tons in Shanghai.
Right. I noticed that it's something like an 85% or 84% decline in a relative 7 months or something like that. Very.
Yeah, since I think April or May of 2013. So but there was a 12% drawdown on Thursday, and they're down to 200 tons now from 1,100 plus.
Wow.
So it's we're starting to see tightness there too.
And then we see, of course, the London Exchange deciding that they're not going to continue on. That is the London fix for silver is going to be discontinued pretty soon, isn't it? It's going to happen soon.
August 14th.
Yeah. August 14th. Interesting. Just as silver stocks in Shanghai are really being drawn down. Now, with respect to gold, of course, nobody.
If I could make a comment there, I would just say that it's perhaps we can see if this follows through, but perhaps is the fact that the silver physical market is going its own way, and as a consequence, there's not much sense in having an official fix on a paper market when the physical market is ignoring the price signals that are being sent from the paper trading market.
Well, that would seem to apply also, in fact, even more so perhaps to platinum and palladium.
Yes.
So, all right, so gold, nobody really knows who has the gold. Nobody really knows how much gold is resting where, but we do know there is pretty solid evidence that China is continuing to pick up huge amounts of gold. Comment on China. I think you've seen some statistics for the first half of 2014. Pretty strong yet, maybe not as strong as last year. What can you tell us about that?
Yeah, Jensen came out with the H1 2014 numbers, and these are withdrawals from the Shanghai Gold Exchange. Roughly 950 tons have been withdrawn, and in context, there's about 1,400 tons in the first half of the year that's been produced from mines.
Mm-hmm.
So, they're up in the 80-85% withdrawal level. So it's very strong. There's a lot more gold above ground. But it is interesting to see this Chinese, China is not driving the gold market globally. I mean, they are one, and they are a substantial component. But China may well be what affects the market and prevents this paper game from going on anymore, both because of the way that their Shanghai Gold Exchange is set up, that it's you have to deposit a bar before you can trade it, which is an interesting concept. And then also we'll start to see the price premium there for actual physical demand. And I think that kind of clarity is going to be ultimately what is the undoing of the paper game, and how they've been able to drive sentiment to a negative in a negative direction towards gold and silver by just pounding it with infinite paper.
Yeah. But that's, what a novel idea. You have to own something before you can trade it.
Or you have to own it before you can sell it. Yeah.
Before you can sell it. I mean, can you imagine that? Yeah. I mean, I would imagine. I mean, it's called naked short selling without doing that, I guess, and it doesn't make any sense to me. It's certainly not something I would ever do. I would want to own something before I tried to trade it or sell it. But anyway, the games that are played in the financial markets by the people that are in power with enormous and endless amounts of money printing capability, it is an outrage and it is immoral for sure. So China's still remaining strong, very strong. I mean, I don't know if you have any comments on India, but it seems as though there may be some strengthening in India too, which had been hurt significantly by increased taxes. But I think I heard there's some reversal possibly in the tax policy with the new government coming in there. But I don't know if you have any comments on that or not.
Well, India announced last week they're entering into gold swaps with the Bank of England.
Oh,
so they're going to be they'll sell their gold into their own market, and then they will have gold given to them in England held for them in the bank at the Bank of England. So
maybe more games. I don't
know. For sure, more games.
More games.
Yeah. So it's they lower the tax, but then they feed the market with gold to prevent it from having an impact on the gold market. And then the Bank of England holds gold for them in return. So it's one of those, it's a shell game, basically.
Oh, here we go again. The same old to a great extent, I guess. But so there's been a lot of talk about the London gold fix, and we hear people talking about the London gold fix. It's corrupt and crooked, and I think somebody in Germany said it might even be more serious than the LIBOR scandal. But talk to us about that. That's not really the issue, is it?
From my perspective, it's a false. It's really a false issue. The question, we need a better fix. So that's been the discussion.
Yeah. A more efficient fix or something.
Yeah. We need something that's open.
Like we need a fix. We can't let the market decide it. We have to have it fixed.
Well, but even
price fixing.
Yeah, but even if we use it in the way that they use it, which is just a daily benchmark price, right? Mm-hmm. Okay, this is the time, and this is where we're going to measure the actual. So we have an official price for the mining sector and everybody else. Mm-hmm. But I mean, that to me is again, it's a distraction. It's not how they come about the price. It's what they're actually trading. And when they're trading, the gold core paper from last year, they're trading 8,500 tons of gold a day versus 10 tons global mine production. That's the issue.
Yeah,
they're not trading gold. They're creating infinite gold and trading it and calling it gold. And that's the core issue, is that the LBMA and the COMEX they're basically frauds. And that's there's no polite way to say it, and that's not something you say in polite company, but it's a complete and utter distraction from reality. And
right.
This is the core issue.
Right.
And so, a new fix, no. You need to have an exchange where you deposit a bar and then you trade the bar. And if somebody else wants to exercise their position, then they take the bar. And that's a real gold exchange, and the Chinese have it right, and I think that they're going to have it right in Dubai, and certainly the Moscow exchanges, and there's another one in Thailand opening up, in Singapore. So these markets are ultimately going to become physical markets, and that's the key. Is that New York? I think the Century Plus of New York and London, increasingly trading nothing and calling it gold, is basically reached its limits.
Well, what would make it stop, though?
Basically, the unavailability of gold in New York and London, because they have a distorted price structure and then a completely different price structure on the physical exchanges. But
there has to be a psychological change, because now I think most people who trade on those markets are just simply, they're betting on the price direction very rapidly, probably with sophisticated computer models. And they're in and out of these markets, and they're not really wanting to take delivery of the gold anyway, are they? So what would have to be a change of heart, a change of demand, a change of desire to see? And so if people actually started wanting and demanding the real thing instead of virtual gold, and then it wasn't there, I guess that would cause a real ruckus.
Well, many mining companies are still selling. They or their agents are still selling through the LBMA. Mm-hmm. And they would forward sell, and the delivery would not be necessarily through the exchange, but the pricing and the trading of the OTC instruments, over the counter instruments, does happen through the LBMA. So when the mining companies are looking at they can get 2 or 3 times the amount of money for their gold on another exchange compared to what they can get in London, then that surely would drive it. And again, back to this platinum palladium situation, that is going to be very interesting to follow, because these are, you've got 15% premia now in the Shanghai Metals Exchange versus the paper market. So we'll see what that drives.
Yeah, well, I mean, unless there's some laws passed that prohibit trading and selling into those physical markets, I mean, you would think, you would think that the mining companies that are producing this metal would, or recycling it or whatever, would want to get the real physical price and not the paper
Top
price.
dollar, top dollar for their product, and
Sure.
they will ultimately. So I don't think you can ban reality. I think it's pretty tough.
Mm-hmm.
And ultimately, I think it's going to assert itself. Until then, people are the markets largely, because of the mainstream media, are basically clueless as to what's going on.
Absolutely, and of course the real demand comes, as John Exter explained so well, with his inverted pyramid, and as the financial system continues down its pathological road, with increasing indebtedness, it becomes increasingly insolvent. There's sort of a chain reaction that John Exter explained. When times are really good, people are buying illiquid assets, they're speculating, they're buying high-risk assets, and everybody's happy and having a party. But when things start to go in the reverse, as they started to in 2008, then you see people selling those items, those extra homes, those boats, those extra luxury items, and so forth, because the margin clerk is calling and she wants to get repaid. Is that something you see sort of unfolding, David, going forward here?
It is. I think that people have been scratching their heads about these the dropping yields in treasuries, and John Exter always predicted there would be what he called a deflationary crash, basically as the debt burden becomes so large from the printing of debt-based money, of creation of excess debt, that the more unsound issuers of debt ultimately start to fail first, and there's a migration. And I really, I do strongly encourage people to look up John Exter's pyramid of assets. But, what he called a deflationary wind down is really people initially piling into treasury bills, because, those would be the financial instruments which would fail last, for which they would not be able to make payment, because they can always certainly turn to the central bank and have them print money to pay. Mm-hmm. So, the view that you would move down this pyramid into treasury bills, and then second from last, you would actually move into cash. Mm-hmm. As the yields turned around, as there's an inflationary wave, then the bond prices would start to fall, and people would initially pile into cash. But then at the extreme point that we're at now, the debt pyramid, the debt structure, is basically unsupportable. Mm-hmm. And so they would go from treasury bills into cash, but then all of a sudden they'd realize, well, this is all debt-based money that's in existence. Mm-hmm. And all this money, this cash, cold, hard cash, which is really, that's what they used to call it when cash was gold. It was
right.
Cold cash.
Cold, yeah.
Now it's, warm, floppy paper,
yeah.
And it's always
going up in smoke.
Yeah. So they'd be, jumping from treasury bills into cash, feeling safe for a few days or weeks, and going, holy cow. This is actually debt-based money. This is as vulnerable as anything, and that's when the ultimate move happens, and the gold price explodes.
Right.
And so, go ahead.
Go ahead, Dave.
No, I just think that we must be getting to that point now. We're hitting the bottom. They've gone negative in terms of yields in Europe, and on savings deposits, trying to force people, into other things, and to use their cash actively. But I just think that we're getting to the point now that the treasury market, when that yield does start to go up, and it will go up at some point, that the half-life of the cash market, in terms of everybody feeling safe for a little while, is going to be very short. And then you're going to have a very, very powerful move into the ultimate assets, of which I think gold is the superlative.
And then perhaps the reset that some people are talking about will be forced by the markets.
Yeah,
I
Hard
don't
to
know.
say. I just don't know. I don't know what the plan is because they've been avoiding dealing with reality until now.
Right.
And it really seems to me like there is no plan, and there's a refusal to plan for whatever the reason is. But the ultimate course that we're on is not difficult to see. You don't have to be brilliant. And I think everybody that's at a high level in the financial system or at the highest levels, certainly of government and the financial system, well know. And I think that the central banks, they well know as well, because we can hear so many of them kind of getting honest here at the last moment in terms of voicing their concerns. So I think they realize that things have a very, very limited lifespan in the paper world.
Well, it certainly seems from a fundamental point of view that it's really hard to see how the system can continue on much longer. But I've been saying that for a long time,
Yeah.
and it seems as though the powers that be are able to keep the balls in the air longer than it would seem possible. So it's hard to say. I know that you don't put too much stock, David, in as you said earlier today, in technical analysis. But I must say that I'm looking at several technical analysts.
Yeah.
Who are suggesting that this summer is likely to be the turn. Dr. Robert McHugh is one, Charles Nanner another that I respect,
Yeah.
and so I believe what you're saying is absolutely right, that the distorted markets, the paper markets, are really fraudulent. At the same time, though, there may be a tinge of reality in those markets. After all, a certain amount of gold actually is exchanged through the LBMA, and
Yeah.
even though it's small. So, at some point in time, I would guess that if people start losing confidence, it could actually be reflected in those markets. And then to what extent the gold bullion banks, the ones that are manipulating these markets, also, they don't want to lose money either. So if they start to see, I guess if they start to see overwhelming change, they might also jump on the bullish side of the gold market. Although I understand recently they switched to being big on the short side, a big huge switch from the bullion banks, which were uncharacteristically long, and now they've gone short again. That's my understanding.
Yeah, it's very difficult to say. It's just there's so many interested parties, and there's intervention by central banks and treasuries and the major bullion banks who have a vested interest in maintaining appearances. So I just the lens of the paper market pricing is greatly distorted. And one way to look at it is if you look at the New York and London platinum price, you're getting one story, and then you look through at the Shanghai price, and you're getting one that's 15% higher. So they might say, well, platinum is okay. It's quite subdued right now. It's kind of, but let's move the price up by $132 and see where you are in your chart. And are you now breaking out, right?
Yeah.
So that's the kind of distortion that I'm talking about.
Yeah, right. Okay, well, I see there's one other thing we want to talk about today before we discontinue or before we conclude our discussion, and that is France versus the United States. You're saying that there's some growing dissension or growing conflict between the two countries?
Yeah, there's some chatter.
The Americans have never been in recent decades have never been too fond of the French.
Yeah.
But something else more serious here than just not liking them because they're so French.
Yeah, well, Total Energy, the CEO came out yesterday and said that there was no reason for the petrodollar. And, Total is an oil company. And you and I and our discussion group, I think, fully understand the importance of paper U.S. dollars and oil. And, that's kind of dropping the gauntlet there. And I think France saying as recently as a couple of weeks ago that it was going to be delivering these Mistral class warships to Russia despite the conflict was another signal that they were going in their own direction.
Mm-hmm.
And then Sarkozy, the former president of France, he's been detained and charged with some racketeering, getting $50 million from Gaddafi, and he was questioned for 15 hours, which is kind of unusual. To hold a guy, and he was the first president of France ever held overnight in a jail cell. So,
there's some other high-level people in France's history that lost their heads, but that's another story in recent history anyway.
So far he's only lost some of his polish, of his reputation. But Sarkozy's comment. This is from a BBC article. I just want to read this. He said, "In our country, which is a country of human rights and the rule of law, there are things that are being organized.
Huh.
The French need to know what they are, and in conscience and freedom, judge what to make of it. So I'm not sure if he's talking about his own situation or greater changes, but there's a whole series of signals that we're getting. Austria signing a deal with Russia there on natural gas last week. And there's a whole series of different pieces that are coming into play, on the greater mosaic, and we'll have to see where they fit in. But definitely France seems to be kind of a focal point of conflict and of heading in its own direction. And going back to the 60s, where France took delivery of its gold on a battleship that entered New York Harbor in return for returning U.S. Federal Reserve notes and debt and U.S. debt. I mean, there's always been this kind of maybe a opposite view of the world in terms of monetary matters, and I given the experience of France with John Law's failed paper assignat currencies, it's not hard to see why they would have a different view of the world.
No, it's certainly not, and I actually have applauded the French for that view. I think that they have a more proper view. In the United States, here we have been very fortunate, and I think dumbed down. I don't think Americans understand enough about history and know what's going on around the world to really understand how destructive paper money can be. But I was thinking also, as you mentioned, all these different things going on around the world. I was reading, my brother does some international trade, and he sent me something from someone in the Ukraine that publishes information to help people trade. And apparently, a lot of commodities are not getting traded now because of conflicts not only in the Ukraine and that part of the world, but also out of Turkey and the Middle East and places like that too, because of the growing levels of conflict is actually keeping the natural trade flows. And I'm thinking about now, if we start to have inflation rates, I'm in my what I call my inflation deflation watch. I calculate it every week. I'm seeing a breakout now in terms of in that measure of let's say asset price inflation. It's not just commodities. It's not just stocks around the world, Chinese stocks, Indian stocks, U.S. stocks, and then some autos and housing and things like that, as well as Chinese. I mentioned Chinese Indian stocks. Then we have copper, which is really in the last couple of trading sessions, several trading sessions, has really broken out on the upside. Oil is strong. So it seems to me that if we start to see some real serious price inflation in some of these commodities, that could really start to get people thinking about these zero interest rates that you're talking about. And we really could see something along the lines of a loss of confidence in the system. None of us really want to see that, I think, because it's not going to be good. It's going to be very bad. But I think it's better to see it than not to be prepared for it if it happens, because it seems highly logical. Sooner or later, it's going to happen. And this whole thing here with Total, I know that Total does a lot of work with Russia, and so it's to ask the Europeans to give up trade with Russia and other countries for what? So that the United States and the Anglo-American Empire can become bigger at their expense. I mean, actually, I think all these European countries are more like client states of the United States. We've made them that way. I've had an expert on Japan who lives in Japan talk about how Japan is nothing more than a client state of the United States, and sooner or later, I think the Europeans might get fed up with it also.
Yeah. Well, on the France point, Germany asked for its gold back from France and the United States.
Yeah.
France started to give the gold back according to schedule, and the United States gave less than 5% of what was requested.
Right.
So I mean, there's a divergence there as well. There may be some frustrations that that the U.S. is not towing its fair share or fair load, and it's playing by a different set of rules. So. We don't know what's going on behind the scenes there, but it was an interesting comment in terms of the implications coming from such a senior CEO. One other note there, Jay, on your point of people realizing that prices are going up and that their cash may be becoming worth less, if not worthless. Is that the central banks? We heard 2 weeks ago that they've bought trillions of dollars of equities in the markets. And the thought occurred to me that this may be them buoying the markets or supporting the markets, although I don't know exactly how they justify doing that. But the second point is that what if these central banks are printing money from nothing and buying stocks which have real value? in the end, these central banks are going to be holding assets when their product, which is cash, is heading south at a very, very high rate of speed.
Yeah.
And it almost becomes then a state takeover of industry on some levels, doesn't it? Because
Yeah.
you have these central banks, which
Sure.
are a creation of government printing money from nothing and acquiring
And
assets.
absolutely. It's a confiscation, essentially. Yeah.
And then the dupes who took the cash in the end are left holding nothing.
Right. Well, and then, of course, you want to exchange your cash for real money, and that's, of course, a theme on this show all the time. Well, thank you very much, David, again, for spending the time with us and passing along your insights. It's always welcomed and I think always very worthwhile for our listeners. So thank you very much, and we'll look to do it again next week, hopefully.
My pleasure, Jay.